The topic for today is how to identify peaks. You should understand that there is no real peak for any company stock. Why? Because the potential for growth and innovation is unlimited. So when we talk about a peak, it means that we want to cash out and we want to find out when and where to cash out. And if you want to do that, you have to be realistic. You have to look at what the big guys are doing. So when the big guys begin to sell, we know that the stock will peak. And when the big guys start to accumulate, we know that the stock will bottom out. Now, what are the important factors? Let me point out first what is not that important. Dividends. The payment of dividends is not that important for a stock to get to the peak. Dividends only produce a temporary spike in the stock price. It doesn't lead to long-term growth. Why? Because dividend is a cash expense that a company has to pay out every quarter. And if the company has to pay out cash, that means it's going to reduce the profit of the company. And as you can see, many companies don't pay dividends, especially the growth companies. They never have to pay dividends. Paying dividend only means that the company now becomes stable and mature. What matters for the peak is, let me point out first, is restructuring after a crisis. When a company restructures after a big crisis, this is a very important factor because it may cause the stock to soar to a very high level. What happens after restructuring? If the company becomes a lean and mean company, that's a good thing. If the company has succeeded in selling all its non-performing assets, that will bring in a lot of cash. And if the company can redefine its core business and also refocus on the customers, that will be a big plus. In that case, the share price will soar. We see this in many examples. The best one is IBM, which has restructured in the early 90s and come out in the late 1990s with the stock prices soaring. And we may have to wait for a little while to see what are some of the big companies are doing right now. Ford Motors is undergoing very huge restructuring. Citigroup and also the big insurer AIG. The number of outstanding shares, very important. Why? The simple reason is that if the company issues more shares, the stock value will fall. Likewise, if the government prints more money, the currency will depreciate. And if the number of shares are small, it means that there is more potential for splits, and split is a good thing. Now, let me give you some good examples about the number of outstanding shares that make the stock price very high. Berkshire Hathaway, you may not be familiar with this company, but when I mentioned that this is a company owned by Warren Buffett, this is a holding company that owns a lot of different companies. And it's a big one. The sales in 2008, last year, was 108 billion. Profit 3 billion. Profit per share really high. Why? Because the number of outstanding shares, as I highlighted here, is very, very small. It's only 14.8 million shares. Very small compared with all the other companies in its category. All the big companies in that category has outstanding shares amounting to about 5 billion. And Warren Buffett has kept the number of shares down. The price per share is about 5,000 October 07, and even during the low point is 2,000 and something. And I want to make you aware that this company doesn't pay any dividend. So with no dividend payment, and it can still achieve a high price. Why? Because the number of shares are very, very small. Another example, Google. Sales 22 billion last year, profit 4 billion. Profit per share also very high. Why? Because you look at the share number is relatively small. The profit margin for Warren Buffett's company is not high, is not impressive. It's only about 5%, which is not big. You look at Google, the profit margin for Google is about 25%. And you also look at the price of Google. This company is growing very fast. In 2 years, from 05 to 07, its stock price has multiplied. I also want you to look at another example, First Solar, which is a company making solar products. Well, this is a new industry, and the company is not yet proven, but is a big one and is one of the oldest in the solar industry. Sales 1.25 billion, profit also high profit margin, and the number of shares is also very small, 85 million, and no dividend payment, so as Google. And all these companies don't pay dividends, but their shares are soaring and exploding, as you can see. For this company, First Solar, in just 1 year, the share has exploded. The third factor you have to look at is innovation. This is very important because innovation is purely a human invention. As you understand, human can break or make the company. So the human factor, in fact, is the most important factor. Innovation can happen in any industry, but it is absolutely necessary for the high-tech industry. For the basic industry, you need innovation to create a brand. I can show you that brands occur in many things. In the food industry, clothing, toothpaste, soap, and many other things. Let me give you a few examples. Coca-Cola, Polo, as in the shirts, Aquafresh, toothpaste, and Ivory. These are brands. Innovation means new organization and new management. It also means new technology, new invention, and of course, new way of doing business. What do we mean by that? You look at Google, the way they do their business is a new kind of business. eBay, new kind of business. YouTube, Facebook, Amazon.com. These are the new ways of doing business. If you want to understand the real power of innovation, all I need is to give you one good example. Apple company. Sales 10 billion, profit 1.6. The share has exploded from 14 to 203. Now, if you ask me what will be the peak of Apple, it is very hard to say because of the innovation that this company is doing. And also, if you look at the outstanding shares, it's not that high. So there is possibility for another split.